Welcome back. To hear it from the president's money men, subprime and the nation's housing woes aren't the big wildfire in the economy right now.
The pace of home sales seems likely to remain sluggish for a time. Sales should ultimately be supported by growth in income and employment, as well as by mortgage rates that, despite the recent increase, remain fairly low relative to historical norms.
The impact on individual borrowers, on homeowners, is meaningful. What we said is we think it's going to be contained, and it's largely contained.
But the markets are worried, and the market continues to trade nervously on just those concerns. Is their talk out of touch with reality of the rest of America? Peter Schiff, president of Euro Pacific Capital, says it certainly is. He's author of Crash Proof. Insana Capital Partners managing director Ron Insana says housing's impact on the economy right now is limited. Also weighing in, CNBC's senior economics reporter Steve Leisman. Nice to have you with us, gentlemen. Peter, let me kick it off with you. What are you saying? You think that this is a bigger problem than the president's money men are saying?
Well, I mean, of course, they're not going to admit the extent of the problem. You know, if you look at what Bernanke just said about interest rates being low by historical norms, but the problem is housing prices are not. They're very high. And the only reason those high housing prices were affordable was because those people buying them were able to use adjustable rate mortgages where the initial payments were affordable. But the resets where they're all going to go over the next few years are not affordable. And it's not just subprime. It's everybody who took out an adjustable rate mortgage in the last few years. I believe that the vast majority of these people are not going to be able to afford their payments, and these mortgages are going to go into default.
Ron.
Yeah, Maria, I would not say that I think that we're out of the woods yet on the subprime contagion, because it's clearly spread to other parts of the credit market. There are concerns about the creditworthiness of mortgage lending institutions. We've already seen a couple go bust. There are worries about any types of funds that have had subprime-related exposure. I think that both the Treasury Secretary and the Federal Reserve Chairman get paid not to publicly panic. And it's been told by many at the Fed to me over the course of my career that that's what they get paid for. They don't go out in public and say, hey, listen, we're going to cut rates tomorrow because we're scared to death that this is going to slip out of control. They do have to take this as a step-by-step process.
Right,
Ron, you know, a rate cut's not going to do anything. I mean, they're not going to be able to repair this by cutting interest rates because the lax lending standards aren't going to return.
Well, I wasn't making that argument, Peter, and two, I was saying eventually rate cuts do have the type of salutary effect that they want after things get sold at bargain basement prices and the market clearing process.
It won't work this time, and especially with the dollar on the verge of collapse.
It's worked every other time.
But the dollar wasn't about to collapse. And if the Fed were to cut interest rates, my bet is that long-term interest rates would actually rise. It would compound the problem. They're stuck.
Steve Leisman, I guess one of the biggest worries over the last week and a half or so was when Countrywide came out, a week and a half ago, and said, look, it's not just the subprime borrowers, it's people with prime, the prime borrowers, people with good credit. What happened today?
Well, today there were rumors circulating around all day, Maria, that Countrywide was having problems placing commercial paper, and they have now out in the last 30 or 35 minutes out with a statement denying it, saying they are not having any liquidity crunch. And I want to just read you that from their statement. It's important to note that the company has experienced no disruption in financing its ongoing daily operations, including placement of commercial paper. Countrywide's financial condition remains strong, as evidenced by over $14 billion of net worth, significant excess capital, and our strong investment-grade credit rating. It's that kind of market. What happened in the ABX market, that's the mortgage derivative market, it hit its lowest level ever, especially in the investment-grade paper. And the cost for insuring Countrywide corporate debt went out 30 basis points wide. I mean, it's more expensive to insure it. That was happening all below the scene. Stock market didn't react to it. Only a modest reaction in the Countrywide stock, and what you saw right there now is because of those gathering rumors, concerns about liquidity, which is really endemic to this market today. Right. Countrywide came out with a statement saying we're okay.
Peter, what kind of evidence do you have that it is such a big, a much deeper problem, more so than just the subprime contained area, as Hank Paulson said?
Well, because we know. I mean, look at a state
How do we know?
Well, look at California. Over the past few years, something like 80% of the mortgages have been ARMs. Now, why would people with long-term interest rates at historic lows take out an ARM? I mean, the only reason was they couldn't afford the fixed rate mortgages. Well, if they couldn't afford the fixed rates, they can't afford what they're about to reset to because it's higher.
Well, could they not afford it, or it was just, I mean, it was there for the taking, right, Ron?
Well,
I mean, you had all sorts of easy lending going on, and you know, if you're able to borrow at a much easier rate,
Maria,
and the mortgages that were out there were just outrageous.
No, people were maxing out their houses. They were borrowing as much as they can at the teaser rates. And you know,
the question, Peter, is what's the knock-on effect from this? And to me, I agree with the idea that the Treasury Secretary and some of the Fed officials, they're beginning to lose credibility here, because I think it has already caught on, and it's caught on in the corporate debt market, certainly through a crisis of confidence in the ratings by some of the rating agencies. That's one way. You see it in the credit crunch today. You see it also in guys like Dick Parsons, who said yesterday some of the subscriber stuff may be down because of housing.
Right.
Rick Wagner from GM said our sales are affected by housing. You saw it in the bad consumer numbers. So I don't think the question we should ask is, has subprime moved on, or has the mortgage problem moved on into the broader economy? The question now is, how much will it move on?
Yeah,
Sure,
we know it's already moved into the broader economy, is what you're saying, Steve.
Well, Maria, I don't think it's, yes, it has. And those people who have been most affected by it have been in the lower and middle income areas, who, as Peter very correctly pointed out, did exactly the wrong thing at the wrong time, which was to take out an adjustable rate mortgage when interest rates were at historic lows. That's when you want to take out a fixed rate mortgage.
But also,
let me just finish for a second. With respect to the widening contagion, Maria, that seems to be underway in the credit markets. We are seeing the seizing up of credit markets in a variety of different areas, whether it's some corporate credits, whether it's still more mortgage-related products, whether there are some other areas of the credit markets that would be very difficult to explain in a short period of time. There are problems here. The risk is that it goes from being a market-related problem to an economic problem. That's when the Federal Reserve is required to step in.
Well, that's exactly what's going to happen. Remember, right now, our GDP is made up of the highest percentage of consumption in history. And the way where consumers have been getting that money is they've been borrowing it. Right. And they've been spending it. Now, the people lending the money are losing their shirts. They're realizing that Americans can't repay what they borrowed, and they're not going to lend anymore. And interest rates are going to rise, credit is going to tighten. And to think that can happen without a U.S. recession is ridiculous. In fact, you guys had a survey today in which 2/3 of the respondents said they thought we were either already in a recession or headed for one.
Right.
And I think that shows you were surprised. You think there's some kind of disconnect between the public and the statistics. The disconnect is between the statistics and reality.
Ron's got the very, very last brief word. All right, Steve, you got the last word. Go ahead. I'm sorry, Ron. I know you always get interrupted. Next time we give you more
I would
time.
just say
we have to get to Governor Rendell.
Okay, what Peter says is a matter of some debate out there in the economic community, which is how much spending did actually come from home equity lending. I think Peter's overstating the case. I think there is an effect.
Plus
I don't think it means the death of the consumer.
Don't forget about ARMs. Those temporarily low ARM payments freed up a lot of extra money.
Okay, I'm the boss here. I am the boss here. I say who gets the last word. Gentlemen, good to have you on the program. We will see you soon. This is a problem, obviously, that we are going to continue talking to. No, you're not, Steve. I'll see you later, guys. Thank you. Get Larry Kudlow's in the newsroom. He's going to tell